This conference will now be recorded.
Good evening, ladies and gentlemen. This is Clueless A Trading Frank. It's approximately 9:13 p.m. on an absolutely gorgeous summer evening here on the East Coast on the waterfront overlooking New York City. It is 9:13 p.m., July 7th, 2019. This is a weekend strategic webinar session. Try to keep it as brief as possible and not just drag it on too much. Want to cover some very important points that are coming up for the following week and going towards the latter part of the month. Those insights have been extremely valuable. Full disclosure, this is purely for financial education, not for any solicitation or advice. Highly encourage everyone to view these webinars as they have been very accurate overall in forecasting these very extreme, these powerful markets and very volatile markets, and have been extremely helpful to a lot of members who have listened to the webinars before they entered the trading week. Doesn't matter whether you're a swing trader or a day trader, you need to be aware of a lot of the pitfalls, a lot of the good stuff that might happen, and what the whole situation is. So I'm going to cover a couple of very important things here. We have Jill. She's a new member who joined us. Welcome, and very passionate to learn. New to the trading business. That means she carries very little baggage, and that's fantastic because you can learn a lot of things from my side, learn things on your side if you're following somebody else or whatever. I'm sure keep an eye on things. You learn from that. We are just giving you very, very effective tools from a technical standpoint so that you can manage your trades better, because that's really what it's all about, and also understand these tactical formations and chart formations that make us a lot of money. So saying all that, let me just cover a couple of broad points here. Very important. We have extremely important week coming up for a simple reason. Just keep this in mind. The most important factor in U.S. financial markets, and believe it or not, in the global financial markets, one of the most important factors that the market is extremely focused on is not just President Trump, his policies, his business policies, his dealings with China, Korea, his dealings with Japan, his dealings with Europe, and other domestic economic policies and such, which we are very, very aware of. And the sudden tweets which cause massive market drops, or a sudden positive tweet which can cause a big market move higher, we are fully aware of that. And that is sometimes a risk because it just suddenly comes from nowhere, and sometimes it's a gift. So we would rather like it to be a gift than a risk, but we have to be aware of that. But one of the most important things in the long run, which really affect financial markets, is the Federal Reserve Bank of America. And the head of the Federal Reserve, Jerome Powell, as I have stated very clearly, is a very patriotic American, a very smart, simple person who tries to portray, who tries to communicate with financial markets and the U.S. population in general, who basically have no idea what the hell the Federal Reserve does anyway, but I know my members do. But they are the central bank. They're the Central Bank of America, and they are basically the most powerful bank that controls. The little things that they do in rate adjustments and things that they say affects everything globally, because 80% of the world's debt is denominated in US dollars. The most valuable commodity that's traded, oil, is traded in US dollars. So US dollar is king. So what the dollar does is directly affected by the dollar is directly affected by what the Federal Reserve Bank of America is saying about interest rates. Are they raising interest rates? Are they going to cut interest rates? And President Trump, in his own fashion, as we know, he's an atypical New Yorker, likes to piss on Jerome Powell, saying he doesn't know what he's doing. Well, I beg to differ. That's kind of just in my opinion, that's a highly stupid statement. To tell the Federal Reserve Governor, who is actually one of the finest gentlemen and tries to do the best for the country, tell him that they don't know what the heck they're doing. Okay, that's really smart. Okay, but what can I say? He's the president. He can say what the heck he wants, right? But saying all that, he's certainly not going to fire Jerome Powell. President Trump, in the meantime, has nominated two other Federal Reserve governors who will be sitting on the council, Federal Reserve Board of Governors, and they are extremely fine individuals. One is this lady, and the other one is this gentleman, and they're excellent too. So this is great. So that's the good part. But constantly ragging and harassing, in my opinion, Jerome Powell, the Federal Reserve Bank of America chairman, is not a very wise thing to do. But the market really doesn't care. He knows that's Donald. It's our Donald. That's what he does, right? So, saying all that, Mr. Powell, Jerome Powell, we have a very busy week coming up. He's going to start with some speeches. This is the congressional and the Senate testimony, I think semi-annual testimony. And let's see what the color of this pen is. And this is the calendar for the week, just so you guys are informed. Remember, I like to keep all my members, not just, oh, I'm a 10-minute trader, I just made $1. Oh, I just made 30% on those options. Frank's great, Clueless trading trade. No, I want you to be a little bit more informed, so you know how to handle the volatility when it hits the market in waves. So you don't sell at the wrong times, and you don't chase the market just because it's going higher. So that's the whole point of these webinars, to have a little bit more of an educated, informed member. Like they say, an educated, an informed customer is the best customer, right? So that's the way it is. That's what I like to do. So Monday is really nothing. You have the government bond auctions and stuff, TD America, IMX, blah, blah, blah. Consumer credit is important. It comes out at 3 p.m. Most people don't even really follow that much. This is important because it tells you how much credit is being used overall by the U.S. consumer, because after all, the U.S. consumer is more than 70% of the U.S. GDP, or the total output of our nation. Right? So our GDP is like going very nicely. We're going above 2%, 3%. And that is certainly a testament to all the great business policies that President Trump has put through since he got elected. U.S. business likes that part very, very well. Doesn't like this back and forth nasty China trade war stuff that is certainly hurting many U.S. companies. But overall, the Trump team is doing a fine job, like he did, like I told you from looking at my last webinar, right? That I had a pretty big hunch that he was going to basically cut somewhat of a framework deal, and that's exactly what he did. It's exactly what he did. That's why the market went up like a rocket after that was announced at the G20 meeting in Osaka, Japan, when he met Premier Xi. So that was definitely a smart move on what he did. Deals take time. These are big macro deals between two great nations, and we are the strongest nation in the world. China is getting very, very strong economically. A lot of smart people there, and they have to change certain things in the way they do business, and that takes a little bit of time. So hopefully they do get a negotiated deal sooner than later. But in the meantime, there's a truce, there's a ceasefire, and that's good enough for the markets. Okay. So consumer credit, which is the GDP, which is us spending, consumer spending is more than 70% of the gross domestic product, or the total output of the U.S. economy, is important, because all of a sudden you see a sharp drop in consumer credit. That means spending is come down, and markets are not going to like it. So certainly when it comes out at 3 p.m. and I post it, these are some very important numbers that I post. Keep an eye on that. The market might have a reaction to that on 3 p.m. on July 8th, but the consumer seems to be quite strong and still spending, and that's a good sign. So Tuesday is what kicks off. Tuesday we have these Senate congressional testimonies, and 8:45 a.m. right before the market opens. So you've got to expect, trust me, because Jerome Powell is going to stick to what he says. He wants favorable. He wants to do whatever it takes to make the U.S. economy continue growing. So that's all we overall want to hear. And that's the reason why we had this monster rally at the last Fed meeting, because he basically said, look, I'm okay with cutting rates at the end of July, because that's the next Fed meeting, just so you know, because I want to have an insurance cut. What's an insurance cut? It means that cut the rates a little bit so that the U.S. economy doesn't stall, because the U.S. economy is going pretty strong, but there are some signs of stalling or slowing, and you don't want that, because then it tips into a mini recession. I don't want to get into a long-winded Harvard economics discussion, but that's how it happens, okay? The U.S. economy is like a big, huge oil tanker. You don't need it to run aground in shallow waters. You want to keep it going, right? So a rate cut is an insurance cut, so that the money keeps on flowing, and it's good. So I believe there will be at least a quarter percentage point or 25 basis point rate cut at the end of July, which the markets would welcome. Some people wanted to get some market participants want a 50 basis point rate cut. That's half a percentage point on the Fed funds rate. That's a lot. I don't think they're going to get that, but hey, who knows? So he starts speaking. So what his tone and everything is very important. So this is a market moving event. Okay. Overall, let's see. We can't predict. I don't think he's going to do a U-turn and say, no, I'm definitely, the numbers came out. The jobs number on Friday were super strong. But it's also a seasonal factor. I don't want to get into that right now, but it's a seasonal factor. A lot of people come into the summer months to work in a lot of service industries, right? Vacations, all these people get hired to work on all the vacation spots. People are going out there. So that has also an artificial boost in the jobs numbers that might have showed up in last Friday's jobs number, which was 224,000, I believe. That was huge. Okay, so this could be an artificial boost. So all of a sudden, the markets croaked and went down 250 points within the first hour because the markets read into it that, oh my God, the jobs number is so strong, the U.S. economy is moving on 12 cylinders, so the Fed is not going to cut rates that much. It's all this game theory and all this stuff, but doesn't matter. Like when we see the charts in a few minutes, I called literally the bottom of the intraday move, and then the markets rallied more than 200 points, almost went positive, and then ended the day down 8. That's the way you do it. All right. So follow my charts. Learn how to see the messaging. Doesn't matter. Didn't feel good when it started to just plummet. Right? Happened for different reasons. Which reminds me, ladies and gentlemen, you have to, whatever it takes, listen to the video cast that I put out there on Google, YouTube, courtesy of two great ACS students, Mike and Serge, who participate on these ACS sessions. It's a back and forth interaction explaining many technical factors, chart patterns and stuff, all within the framework of the month of July and Friday. And I explain exactly what had happened, why it happened. And then we talked about a few stocks on the swing trade side. So you gotta listen to it. If you don't, it's your loss, not mine. Okay, Jerome Powell starts speaking. Very, very important. Then we have James Bullard, another Fed governor, speaking. Oh boy, not very important. 10 a.m. But he's the big kahuna, right? He's the big whale. So Jerome Powell. Then we have the Joel's jobs report. That's important. 10 a.m. Then you have then we have Raphael Bostic. Oh my, another Fed governor speaking at 1 p.m. Then we have Randall Quarles. He was nominated by President Trump, so he's excellent too. At 2 p.m. So you got the big fish, and you got three other the Fed governor speaking. Very, very important. That's Tuesday. Come Wednesday, the Jerome Powell testimony continues. 10 a.m. Again, big market moving thing. Everyone's going to be listening very carefully to what he's saying. And look, they speak very proper English. Half the time, people don't even understand what the heck they're saying. I do, and I know many of you do, I'm sure. So, they use a lot of technical words and stuff. You can parse in between that, figure out what they're saying. But he's quite direct. Jerome Powell's quite direct. Okay, and then you have James Bullard again. Oh Lord. Okay, so you got more Fed speakers. Again, this could lead to more volatility, up and down, up and down, up and down. All right. I read an article saying this might derail this rally that we are having. Who knows? If they completely turn and say, no, the strong numbers are too strong, we're really not looking to really cut rates too much. Oh boy, markets are going to fall. Just letting you know. The markets are juiced up on rate cuts coming up. I personally think, but what do I care? Well, who am I? I'm just like nobody, right? I think that there's no need for a rate cut. Why? Because the US economy is going strong. I believe one rate cut should do it. You see, the rate cuts are not just for us. It's for the global economy. The global economy gets helped a lot because when you cut rates, then the dollar weakens a little bit. That allows all these emerging nations who borrow using the U.S. dollar in U.S. dollars. It's cheaper for them to pay back their debt. That's all. So the liquidity system globally continues. So a rate cut is good, not too many rate cuts. So anyway, then you have the FOMC minutes, the Federal Open Market minutes. That's from last Fed meeting. So the minutes of the meeting, the notes of the meeting, the summary of the meeting comes out. That's very important. So Wednesday is a very, very important date. Thursday, let's move on to Thursday. Very important numbers, inflation numbers. If these are too hot, that means not good. If they're too hot, that means inflation's picking up. It ties up the Fed's hand a little bit more in cutting rates. So we want a moderate inflation number, not a too hot one. Okay, that's it. Jobless claims, yeah, it's fine. Job growth is going very well, so jobless claims, is an indicator how many people are claiming unemployment benefits. So it's important, not that important. Jerome Powell again. Oh boy, Thursday. Told you it was going to be a busy week. Then we have John Williams, another Fed governor. Lord help us. Okay. Then you have Randall Quarles again, and John Williams. So just think about how many. I know you got the big one, Jerome Powell, in 3 days in a row. Then you got all these other guys all the way through. So this is pretty. Oh, there's another one. There's Neil Kashkari right there. I'll tell you, a lot of them. Friday, you have the producer price index. That's inflation on the raw goods that go into manufacturing. This is consumer price inflation. This is the basket of goods that we consume. So this is the industrial version. This is the consumer version. So producer price index comes out at 30 a.m. Again, we don't want it too hot. We want it kind of moderate so the markets can move on. So it's going to be a busy week, guys. Okay, it's going to be a lot of volatility intraday, back and forth, back and forth. So forecasting is fine and good, all the technical stuff that I do, but be prepared for some heavy duty volatility. So don't go overboard with trades. Certainly do trades. This is a very selective market. I'm showing multiple stocks which are just going through the roof. It doesn't matter what the market's doing. Even though the markets were down 250 points, we had stocks which are going the other way, like United Healthcare and those HMOs. And then you had Roku going through the roof. There was a bunch of things. And then the market turned, then boom, we had a huge reversal on multiple stocks. So it is a very technical market. It is selective. This is not a straight line. This is in grandpa's market. I've said that a zillion times. You guys might be sick and tired of listening to me say that, but it is a fact. This is definitely a very technical market. And you can see that clearly in this picture of the month of July. This is the month of July. Futures right now are down about 2.5 points, nothing big. Globex futures I'm talking about. The China market's about to, I think, just opening now. So the things which will dominate are the Fed talk and, of course, news about China, which has been that they have started talking again. They've always been talking. I don't know why they say we just started talking. They're always talking. So and that type of stuff is very important. The other thing that we have to watch out for, if President Trump goes a little bit bonkers on tariffs and stuff against the European Union regarding autos, market doesn't like that at all. It's going to hurt us and them badly. Why? Because all these companies have huge auto plants in the US. BMW does, Mercedes does, Volkswagen does. I don't think Audi does. They manufacture a lot of these cars in the US. Anyway, so we have to keep an eye on that. Keep you guys posted as much as possible. So this is the month of July. I don't want to get into a detailed explanation of all these massive patterns and this and that, but just look at this chart. It's like volatility. Even though we hit new highs, which I said we would, and we still have a shot to hit higher highs, did it happen in a straight line? Never. It had structured patterns, and that's when it reached there. Then it created the double top, all explained on the last video. So I'm not going to really fall into the trap of explaining this chart again. Then a massive drop on Friday on the strong jobs number, huge reversal, and now futures down about 3.5 points. So if you just look at this, ladies and gentlemen, how could you not respect these structured charts that are put in place to help you all? Now, you can be a swing trader, you could be a day trader, but these are all accessible to you on a 15-minute, 20-minute, 30-minute basis on the real-time Twitter feed that you all have access to as paid members. So, all done to your benefit. Doesn't matter how crazy the market gets. Okay, and in between, there's going to be selective stocks. I'm trying to be as selective as possible. Biotech buyouts, individual stocks that are moving on M&A, mergers and acquisitions, sell-off. I mean, what do you call buyout type of news. So I'm focusing on that type of stuff. So please review that last video. So this is your picture of July. Expect this volatility. Once you get prepared for it, it's not going to freak you out. What freaks people out in life not just in trading, is when they're not prepared what might come in front of them. So if you already know that there is going to be some many dangerous situations coming in front of you, you prepare yourself for that so you don't freak out. You react accordingly. So the same thing with trading and investing. I'm showing you exactly what these levels are, where they can bounce from, where they can fall to. If all hell broke loose on Friday, we wouldn't have gone through and retested this neckline. Again, listen to the last video. We would have fallen all the way down here to 29.55, which means we would have been down 300 plus points on the Dow. Instead, we did this technical move. And again, listen to the last video that was put up there over the weekend. Thanks to Mike and Serge for allowing me to put it up there. After all, they paid for their ACS sessions, but I asked their permission and they said, sure, go ahead and put it up there so other people can benefit from it. And maybe some of you who are serious about trading and managing your profits and losses will also sign up for the ACS or advanced coaching sessions. Let's move on to the next chart. This gives you a slightly a bigger picture. That's a 15-minute chart, so more noisy. This one has less noise. What is noise? Noise means volatility, chop, chop, chop in the market. You can see a defined structure. We basically had we had a large rising wedge. Then we had a consolidation that lasted for a couple of days, all called very accurately. Look at my Twitter feed, look at my videos, or what I said then, and the lines are drawn. This is the Fibonacci retracement chart. That's where we had these dotted lines, right? The thick blue dotted line is the 50 Fibonacci line. The 50 Fibonacci line is basically the maximum point where it can drop and bounce off from. These mathematical patterns work, as you have all seen repeatedly, but we never even got close to it. We hit the 78.6 Fibonacci and we turned from there. So from a chart pattern standpoint, this is a rising wedge, a consolidation channel, still a bull flag, and then the bull flag broke out and zigzagged its way to 3005, which I said we would go to. I said 3006 to 3008, got 3005, and now we are here. So when you look at the 1 hour chart, which is a longer term picture, more of a wider picture, then it looks, it's just like there's really no technical damage. The real technical damage comes into play if we break below this breakout high, which was around 2969 or 2970. And as technicians, we watch this very carefully, because once it breaks that, then the pattern is no longer it's nothing crazy, but that means the market is in danger of falling back to the 2900 level, which means we'll be down quite a few hundred points from here to here. That's about 400 points or so. So this was 250 points, so this would be 400 to 500 points. So that'll do some serious damage to individual stocks. So we have to be prepared for that, and we will certainly short the market as I normally do, and you guys can short the market any way you want, individual stocks included. I short the market using SPY puts or QQQ puts and weekly puts and things like that. So I will certainly be keeping a close eye on it. It is overall, as I will show you on the longer term picture, still the primary trend is higher in the market when we look at the daily and the weekly charts. Yes, we get these pullbacks time to time, intraday, overnight. Futures are down about 5 right now. I bet you China's down a little bit, so that's why. So the key is that shouldn't derail you from making the big money, because the market overall is going higher. Now, which brings me to an extremely important point. And this I was discussing, I was explaining to one of my other new members who started to do the advanced coaching sessions with me. So I explained to her, look, bull markets continuously going higher are really not a good thing. You know why? It's not a good thing because you're on certain individual stocks, you're just chasing higher and higher and higher prices. So when you say, oh, the market's hitting a new high, the market's hitting a new high, I thought about it this weekend for a minute, you know? I said, is that a good thing? No, I don't think it's a good thing. I want markets to pull back 600-700 points so you can buy a $150,000 Porsche at a bargain basement sale of 40,000. Wouldn't you run to the dealerships and say, look, give me that? Let me put down a little bit of money and make the payments, because that's a $160,000 car or $200,000 car that's being sold for 40. That's what happens when markets crash. You get these huge bargains on these great companies, so many of them. yet no one steps in to buy. We do. We do. I'm not just saying it. Look at my videos. Look at my Twitter feed. We even did that on Friday. We're down 250 points. Told you where the market was going to bounce, and we bought. So that's what I'm saying. That we actually want markets to go on sale. Now we want it to go on sale when we are either buying SPY puts short, so we're making money, or we don't have too much on the long side, because then you're going to lose that bunch. So we have to be light in our positions or no positions with some SPY puts or VIX calls. I like the SPY puts better, or QQQ puts. These are index puts, weekly puts, overnight or intraday, and let the market go on a little sale. And we can buy things cheaper for these big vicious bounces that come along the way. This happened on June 3rd. We called it. It was getting really tricky. We called it. Then it slipped a little bit more, and then I called. Look it up. These are big time calls, guys. Even what I called on Friday is a big time call. You don't get that with other services. I'm dead serious. I'm not saying there's a lot of smart people out there, a lot smarter than me. But when it comes to understand the dynamics of volatility and what certain economic things mean, whether or not it's a real danger to the markets, if not, I am very good at it. And you guys know that. And try to share that with all my members freely. So the key is that that we want. So the thing that I want you to all think about after you listen to this is we don't want a runaway bull market that keeps on making new highs every day. We don't, because that doesn't allow us to get in. I know a lot of stocks are cheap with a lot of upside left, but just in general, we don't want to keep on chasing in Netflix higher and higher and higher. By the way, Netflix is not at its high at all. The high is $420. My last video explains the whole chart, and if it breaks out of this base, please listen to it, the video from this weekend, where it can go. I'm pretty bullish on that company, as you know. So bottom line is that the bottom line is you don't want a runaway train market going higher and higher and higher and higher. All it does is put people in harm's way. So you want markets to ease back at times, have these resets, have these pullbacks. Rising wedge, consolidation channel, rising channel, little consolidation. It's okay. A consolidation even down here to the 2900s, it's okay. Listen to, I never say don't listen. Listen to all these so-called pundits. Majority of them are so bearish on the US economy, and I'm talking from Wall Street to all these great institutions, these guys. Oh, we're recession coming. Oh, blah, blah, blah. This Trump economy is all fake. Like, what the hell are they talking about? Very few of them are bullish. Forget about the average trader. They're all scared stiff all the time. But I'm talking these so-called brains of the financial industry. They're like totally idiots in calling the market. They're always bearish on the market, and the market keeps on running higher. So yes, so we do not want a runaway train. We do need consolidations to allow us to do the right thing. Okay. Mass psychology says that if everyone wants the market to crash so that they could buy a little bit cheaper, then it's not going to happen. It's going to happen when people least expect it. It's a law of mass psychology. Just the way no one expects the market to rise, everyone's like, oh, market's gone. You listen to turn on the TV, they're like, oh my God, it's all over. We're going into recession, like a big asteroid's hitting us tomorrow, and we're all just going to be like gone. That's going to be the end of the world, right? Basically, that's how it's going to happen. You get huge asteroids going to hit Earth, and it's going to be like the dinosaur thing. All of a sudden, poof, gone. So at that point, you won't have to do any trades, right? Exactly. So all kidding aside, till that happens, keep trading. So on a way up, consolidation, way up, mini consolidations, way up, another consolidation, all bull flags. This one, another little consolidation here, pulled back 250 points, consolidation, moved up. So that's your medium-term picture. Still looking like the markets want to go higher. Now, this is your daily chart. Now, the daily chart is a little bit overextended. What does overextended mean? Well, simple. It means it's overbought. It's a little bit, from a technical standpoint, it needs to breathe out some air. Just the way when you're running a sprint, you have to stop, take a couple of deep breaths, and then just run again. When you're not in a sprint, but in a marathon, you got to keep going, right? So you slow down sometimes, then you move fast. Sometimes you keep on running at like freaking 10 miles an hour, whatever, fast. You'd be out of breath when the first, and you won't win the marathon. It's the same thing with trading. So at this point, we have a minor consolidation move, as you can see that, still looking like a bull flag. This was June 3rd. This is when I called the falling wedge. Listen to my videos, won't get into it. And I was dead right. And on the internal, I said, watch out for this falling wedge. When this starts to happen like this, you better get in there hard. Oh boy, what happened after June 3rd? See you later. See you later. I called the falling wedge when we are falling down here on the stochastics. Remember, this is the internal indicator, the vitals of the market, right? And then bang, once it came out of this falling wedge, no stopping. 1, 2, 3, 5 days in a row, the market's up 1,000 points. That's just the way it works. So now it's getting a little toppy, as you can see on the stochastics, and we should, and if it does pull back, I expect, then please, the other video that I keep on repeating, the ACS video with Serge and Mike, I explained this very clearly. I want all of you to listen to it so you don't freak out. All right? There's a chance that we come down here. That's your line in the sand and bounce. So the market can pull back a little bit, retest this breakout. Remember, this was a substantial breakout. We called it. Each one of these lines are drawn to extreme precision. So if you are trading, let's say, SPY calls or stuff, you better be following these charts hard. So you're going to, number one, make a lot of money. Number two, you're not going to do stupid things. And number three, even if you do stupid things, you'll do less stupid things. That's what I tell myself. That, okay, I'm allowed to do some stupid things, but let me do lesser stupid things and more clever things. That means I'm going to come out ahead. And that's the name of the game. So this is your big breakout, right? You can see that. Jill, you following us so far?
Following.
Good. Trying to keep it simple, and you're a fast learner, you'll get it. So this is your big breakout, right? This is your V-shaped move. It hit that. The first attempt, it pulled back for 3 days. Then the second attempt, it went again. So this is basically what we call a cup and handle. A cup, a handle, and bang, a breakout. That's how it works, ladies and gentlemen. But once it does that, there's a little bit more room to move, but this is getting a little toppy. That means the market maybe needs a little refresher. That refresher can easily come within a matter of hours on Fed Chairman Jerome Powell speaking or being questioned by the senators and the congressmen and women and the panel, okay, House panel and the Senate panel. They could ask some really tough questions and stuff, and if he slips on some of the answers, which he doesn't, he's a pretty straightforward guy. He's not a politician, and those guys are always trying to trap him, okay? Both the Democrats and the Republicans are the same when it comes to the Fed. They always like to criticize the Fed. For what? The Fed are a bunch of solid thinkers. The politicians are a bunch of overall just like trying to get votes. That's it. So leave Powell alone, ask him some decent questions, and we move on. But that little slip and slide, the market can very easily drop another 100, 200 points, retest this. Remember, this is a very important. This is a V-shaped or a cup. So you got that big breakout, and that big breakout is right there. You can see that the number is 2765, 64. So the market right now is at 28,986. If it drops to 2964, that's about 22 points. That means the Dow can drop 120 points fast, just like that. Nothing to freak about, ladies and gentlemen. It's just a retest of this breakout. It can slip a little bit. That's why I have these lines here, and you can replicate these charts on your side or just simply follow these charts. So will there be we have a large cup here, a handle, a breakout, another pullback. As long as these lines, the mid-Bollinger, the 34-day moving average, and the 50-day moving average are continuing, excuse me, as long as these lines, that's the most important thing, as long as these lines are angling higher, and this starts to need to angle higher. I mean, this 50-day moving average, yes, it's kind of flattish. What we would like to see as people who are bullish on the markets overall, we want the markets in between pullbacks and stuff to go higher. This needs to curl higher. We have that on the 34-day, as you can see it, the angle. This one's still kind of flattish. Interesting, right? So it's a longer term average. It's 50 days. This is 34 days. This is the mid Bollinger, which is just the Bollinger bands. So it's the mid, there's your Bollinger band. So this is the mid one. But aside from that, the moving averages, this one needs to start to move up a little bit. In the meantime, I do expect a minor pullback the first part of the week. Who knows? Might be getting it as early as tomorrow, Monday, on the Jerome Powell thing. So it's going to be a little bit choppy week, all right? It's going to give us some opportunity to buy things pretty cheap, and some of our more swing trades and stuff that we have pushed out towards July 9th, the 19th, monthly strikes. I hope one of our biotechs get bought out. We just had one buyout. Allergan, Jill enjoyed it. Our new members, some other new members enjoyed it. Fantastic. $1-2 calls went to 34 bucks. So imagine if you had a bunch of them, what would happen? So those biotech buyout candidates that I keep on showing, yeah, they go back and forth, but you have a little bit of it, and you keep on rolling them out every month. At one point or another, I'm pretty certain that one or two of them are going to get bought out. Okay, so that's your longer term, that's your longer term picture on the overall market. That's your daily, and it's come a pretty long way. It's come a long way, okay, as you can see right there. Now the same chart, if you look at it on Thinkorswim here, this is the same chart, except it's on Thinkorswim. Something is about to happen here. So I want to show it to you guys, okay? This would be a very bullish event, a very bullish event. Let me draw one line in front of you so you can show your channel what could happen and what our upside can be. Also keep in mind that we have earnings season starting, right? Second quarter earnings are going to start being announced starting this week and next week. So that's going to have a major effect on the markets. If big companies start to say that their earnings are starting to slow down, market's not going to like it. Earnings, the Fed, those are the most important things. Of course, the China policy and President Trump, what he's doing and stuff also matter. So we have a lot on the plate, and that's why you need clueless day trading. Otherwise, you're going to be a lost babe in the woods. Okay, I'm talking to everybody because you won't know what the heck is going on. We are certainly here to guide people, not just technically, but on a fundamental basis, keep them appraised of all the big factors that move the markets, and that certainly will help them make more money. So this is your acceleration channel. You see that? So upper end acceleration channel, if things go really, really bullish, like go nuts and the earnings are good, we do get a China deal in hand, all kinds of good stuff happen, and we go to 31.05. Let's do a quick calculation where we are. Right now we are at 29.85.35. If we go to 31.06, so we are at 29.85 minus 31.06. That is the upper end of the channel. It is 121 points or 121 E-mini handles. 121 times 7 is 847 points. Just from here, I gotta change this pen color, hold on. Just from here, where we are right now, this is a live chart, obviously. Futures down 3.5 points, nothing big. So this is a 847 point move. So let's say 850 to 900 points are left on the Dow by the time all is said and done. Is that the end of the world, like at the top of the market, and then the asteroid hits us the next day and we just disappear like the dinosaurs? No. The ice age doesn't begin just because an asteroid hits us. But 850 to 900 points, if we get that, my gut tells me, if you listen to one of my older videos, that we get that by Labor Day. That's September 2nd. Okay? And in between, there's going to be some pullbacks and stuff like that. But if things go or everything falls into place, we got another 900 points or so on the Dow Jones Industrial Average to take us up there. Technically, that's what it's looking like. In between, we could go and take a nice detour. We could even come down all the way down here, then move. That's just the way markets do things. You can see that clearly. This was the most monumental time to buy the market after the Christmas Eve massacre, December 24th. I don't want to keep on repeating that. I've done so many videos on that. We started buying here. We slipped and slid. We were red on December 24, and then December 25th, December 26th, the market went up almost 1,000 points, if not more. Bang! We still called it. We didn't have huge long position, but we have decent position, and they just went berserk. And then the market just kept on climbing. A couple of days red. Market just kept on climbing, kept on climbing, kept on climbing, all the way up to May, when it reached a new high, which was close to the previous high. So right there, the market went into a corrective phase, what we call the consolidation channel. Bull flag. Went up, in between pullbacks, of course. Bull flag, now this is happening. So the upper end of that happening is a 900-point move from where we are right now. These don't happen in one day, but neither does it take years. It could happen in a week or two. Okay? One China deal saying, okay, worked it out. This is the framework. Boom, market will go up 600-700 points. We'll just hit it there, right there. And by that time, the market will be severely overbought. That means it's time for a nice pullback. Or we could have a pullback starting now. Now, here is what's going on. And this is something all my older members, especially the ones who are more technically orientated and have spent time taking the advanced coaching sessions and stuff with me, know very well what I'm going to show. This red line is a critical line. It's the 50-day moving average. This orange line is the 34-day moving average. So what is about to happen, as you can all see live, it looks like the 34 wants to cross over the 50. Think about that for a second. Give me a second. Perfect. So what we are starting to see, and these are monumental things, all right, is that the 34 is now wanting to cross over the rising 50-day moving average. The last time it did that, the markets rallied for months and months, in between, of course, a couple of days when it pulls back. These are big moves. Here, because of this big sell-off in December, the 34 actually crossed below the 50. But by the time it had crossed, the market was already rallying, but it was turning, right? And it was turning to cross below the 50-day moving average. The markets were selling off. This is just one thing to look at, but an important one. Moving averages are very important. It's the moving average of the prices in the market. So if this crosses over and continues to cross over, and the angle of this 50-day moving average is moving higher, then you are going to get a sustained rally that will last for a few more weeks, if not months. I'm going to wrap up the session with showing you. So that's a very critical thing that I just mentioned to you guys. So here we are. We have the SPX 533, which all my other members, not the newer ones, know what this is. So I'm going to try to keep this real simple. This is your daily chart. I'm not even putting the parameters in there. This was the hammer reversal that we saw on Friday. Right there. That's a nice hammer. The stochastics are still higher. That means we have a little bit more room to move. Once they start to cross down, that's when the market has these 1 to 3 day corrections. But we're not there yet. You can see that. That was a beautiful hammer reversal that was identified and notified to all my members. But the RSI is starting to weaken, so that's a negative. Nothing crazy, but if we get into this deep dive RSI going down to the serious oversold level below 30, you get big vicious drops in the market that are worth anywhere from 400 to 600 points. And then the market turns around and goes, right? This happened on June 3rd. I'm sorry, not on June 3rd. This happened at the end of June. So I'm going to be monitoring all this stuff for you all. The MACD is still looking good, still positive, still moving higher. Let's take a look at the weekly to get a quick snapshot as to whether or not what the picture is. The weekly picture is damn good from a technical standpoint. Look at this. RSI still climbing, still not into that 90 plus range yet. It's at 90.66, can go higher as high as 100. You got that nice crossover that happened on the stochastics back on June 3rd. That is still continuing. The hammer continues. And here's the best part. I told you all during this period that the histograms would go positive. This is the third week of being positive. Now, if we go back and see how many weeks these histograms, which are the pillars that hold up the market in a way, can remain positive, let's go, instead of 2 months, let's go back 5 months and look. That's how you learn, okay? When this happened back in January and then the markets turned around after the December crash on December 26th, the histograms went positive and rallied, and this is a weekly chart, the bigger picture. 1, 2, 3, 4, 5. This is the 5th week, and on the 6th week, the histogram still kept on going, but we had 1 week of a big fallout. Didn't do anything. The histograms remained, the pillars remained the same, then continued, and the market continued higher. Here, we only have 1, 2, 3 weeks of the histograms going positive. So we can, technically speaking, have another bunch of weeks going out there in between intraday pullbacks and chop, in between intra-week pullbacks and chop, right? Resets, pullbacks, retracements, oversold, overbought condition. As long as the weekly histograms keep on getting bigger, that means the market will continue to go higher overall. That's why I'm saying we could still have, in shorter term, within the next week to 10 days, another 100, or maybe this week, 100 to 200 points under the belt. Now, keep in mind, when we get towards the middle of July, which is comes into play this Friday on the 12th, the dates of 12th to the 17th, let's say, July 12th to 17th would be volatile periods. Always like that, mid-month, so let's be aware of that. But then at the same time, it doesn't have to be the 17th. It could it could be the 16th, that the monthly options expiration, I repeat, is the 19th of July. July 19th calls, right? So monthly option expiration, 90+% of the time is a positive event going into the morning of options expiration, which is Friday. On that note, have a great evening. See you guys tomorrow. Stay selective, stay flexible. Any quick questions and stuff, come in the chat room, ask me, or DM me, direct message me on Twitter. Do not text me and stuff too much, because I'm trying to provide some serious actionable content to you guys every single day, so I can't be looking at my text. Okay, use the direct message feature on Twitter, which is highly effective, or just come into the chat room. On that note, God bless you all. Hope you all had a great weekend. And let's start the battle Monday morning. Should be a good one this week. Good night.